Welcome to another episode of the Discover Potential podcast. Today, we're going to look at the dTAO or subnet market because I actually did an analysis and I want to share this with you because I feel many people, many dTAO investors are going through this same analysis right now and they just wonder why does my subnet need to have a certain value? Why can't it be 2 times higher, 2 times lower? Okay, so first and foremost, dTAO is very early. It's been created in 2025 and the market still doesn't know how to value subnets. It's one of the most ambitious experiments in crypto. It turns BitTensor into a market-based allocation system where subnets compete for tau, emissions, miners, validators, etc. And in theory, it's very powerful. Instead of one central entity deciding which AI networks deserve capital, the market continuously reallocates capital toward the subnets it believes are most valuable. But this also creates a hard and uncomfortable question. What is the subnet token actually worth? And at the moment, I think the honest answer is the market doesn't really know yet. And this doesn't mean that dTAO doesn't work. It means dTAO is extremely early. We are probably closer to the internet in the 1990s than to a mature financial market. So many subnets will not survive. Some may become very important. Most will be mispriced for long periods of time. And investors need to be careful because high APY can easily hide extreme price risk. Technically, a subnet token has a price because every subnet has its own liquidity pool. And the price is determined by the relationship between tau reserves and alpha reserves, or subnet reserves, subnet token reserves. But the technical explanation doesn't answer the more important question. If a subnet trades at 0.057 tau per token, does that mean the subnet is fundamentally worth 0.057 tau? And the answer is not necessarily. It means that this is where the market currently prices a subnet token based on staking flows, unstaking flows, liquidity, emissions, confidence, speculation, and narrative. Take a fine as an example. If a fine trades at 0.057 tau, which is the case today, I think, could the subnet still technically function at 0.01 tau? The answer, the uncomfortable answer, is probably yes. The code doesn't stop working because the token is 10 times cheaper. Miners can still mine, validators can still validate, and the subnet can still produce outputs. But the lower price does matter economically. A lower subnet price can reduce the dollar-denominated value paid to miners and validators. For compute-heavy subnets like chutes, that can be a serious issue because GPU costs are real. If miner rewards fall too far, the subnet may struggle to attract high-quality supply. For lighter subnets, the effect may be less dramatic because operating costs are lower. So the answer is nuanced. A lower subnet price doesn't automatically break a subnet, but it changes the economic gravity around it. Let's take a look at chutes, which is the number one BitTensor subnet. And it's not an empty narrative subnet. It has real usage, real revenue, serious infrastructure, and a visible buyback model. It's very transparent. Every day, I think since the beginning of this year, its revenue has been more or less $10,000 or $15,000 per day, which is used to buy back its own token. And is one of the clearest examples of what many people hope dTAO subnets will become: useful digital infrastructure with revenue that supports the subnet token. And yet, the token has been completely destroyed in price terms. Because when dTAO launched in 2025, chutes initially traded around 0.4 tau per token, and more recently it has traded around 0.067. So, what is it, 8 times less or something like that. That's a decline of more than 80% in tau terms. And so, for an investor, this is brutal. Imagine staking 1 tau into chutes near 0.4 tau per token. You would receive roughly 2.5 chutes tokens, and if the token later trades around 0.067 tau, those 2.5 tokens are worth only around 0.17 tau before accounting for staking rewards. That means your position has lost more than 80% in TAO terms, not considering staking rewards. And even if you bought Shoots more recently, let's say February 2026, when it reached a price around 0.11 TAO, you would still be down a lot with the current price of 0.067 TAO. So this is the key lesson. Even a serious subnet can produce terrible investor returns if the entry price is too high. And that doesn't mean Shoots is bad. In fact, the opposite may be true. Shoots may be making real progress as a product and as infrastructure. But the token price can still fall if the market previously overpaid, if emissions create too much sell pressure, or if broader sentiment weakens, or if revenue is still too small relative to the token valuation. And this is one of the most important points for dTAO investors to understand. A good subnet is not automatically a good investment at every price. Buybacks, for example, they matter, but they are not magic. The theory behind buybacks is simple. If a subnet generates revenue and uses that revenue to buy back its own token, it creates structural buy pressure. This can partly offset minor sell pressure, and it can make the token scarcer. It can align subnet success with token holders, and if the buyback pressure becomes large enough, it may help stabilize the token price. And this is the optimistic dTAO model. A subnet generates useful work, users pay for that work, the subnet uses part of the revenue to buy alpha back, and investors notice more TAO flows into the subnet receives more emissions, miners earn more, the service improves, more users come in, and more revenue is generated, and more buybacks happen. That's the flywheel. But the current market does not always price it correctly. Shoots has buybacks and revenue, though not enough to offset minor sell pressure entirely at this moment. Yet its token has fallen heavily. Another subnet, Bitcast, has shown a clear revenue and buyback policy, and I believe it's the first subnet to have fully offset minor sell pressure. Yet its token has also seen quite some price weakness over the last couple of weeks. Subnets Yanes and Red Team reportedly perform daily buybacks and trade around extremely low levels, around 0.004 to 0.006. Meanwhile, other subnets without obvious revenue or buyback discipline can trade at much higher prices. And this creates a very uncomfortable question for revenue generating subnets. Why do buybacks if the market does not fully or really reward them at this moment? If a subnet like Yanes or Red Team spends real money every month buying back its token, while many higher price subnets generate no revenue and perform no buybacks, the rationale of frustration is obvious. From the team's perspective, it may feel like throwing money into a market that's not paying attention. But this is probably a temporary feature of an immature market, in my opinion. So in the short run, prices are driven by narratives, founder reputation, category excitement, trader rotation, and speculation. But in the long run, if dTAO matures, the market should become more demanding. It should begin to distinguish between subnets with real revenue and subnets with only promises. It should begin to value transparent buyback policies. It should begin to punish subnets that extract emissions without returning value to token holders. The question is not whether buybacks matter, but how long it takes before the market starts caring enough. And in my opinion, the market currently prices many subnets almost randomly. And this is my biggest concern with the current dTAO market. There are research-based subnets with high valuations. There are revenue-generating subnets with very low valuations. There are agentic subnets with extremely high prices, partly because they are associated with important people in the potential ecosystem like Const. And there are subnets with almost no visible revenue, trading higher than subnets that are actually buying back tokens every single day. And this doesn't mean that the market is stupid. It means the market is extremely young. And in early markets, narrative often leads fundamentals. A subnet connected to a powerful future category, such as agents, decentralized inference, or AI research, may trade at a premium even before revenue appears. Investors are not only pricing current cash flows, they're pricing possibility. And that can be rational to some extent. And this is also how many stocks, for example, work. For example, a subnet like Minos may have no meaningful current revenue, but still trade higher than a revenue-generating subnet like Yanes or Red Team, because the market believes its future potential is larger. An agent subnet like Arbos may trade at a high price because investors believe agent infrastructure could become one of Bitenso's most important categories, especially if it's associated with highly respected ecosystem figures. But there is a fine line between pricing future potential and pricing air. Right now, much of dTAO sits on that line. This is why investors should be careful with simple stories, like this subnet has 120% APY, this subnet has a famous founder, etc. And even, unfortunately, this subnet does buybacks is also not enough by itself. So the real question is whether the subnet can create durable value, defend its position, attract users and align token holders, and survive long enough for the market to recognize that value. So what does a subnet token actually represent? And this is the central question behind dTAO. A subnet token is not equity. It doesn't give legal ownership of the company behind the subnet. It doesn't give a contractual claim on revenue. It doesn't automatically entitle the holder to cash flows. Instead, a subnet token represents exposure to a subnet's position inside Bitenso's incentive system. That position can become valuable if the subnet attracts TAO, receives emissions, builds useful infrastructure, generates revenue, supports its token through buybacks, and maintains investor confidence. But none of this is guaranteed. This makes subnet tokens very different from traditional financial assets. They are not clean equity claims. They are not simple yield instruments. They are liquid coordination assets in a live economic game. And that's both the beauty and the danger of dTAO. One of the most dangerous mistakes in dTAO is treating APY as if it were the same as return. It is not. If a subnet offers very high APY, but its token falls by 50, 70 or 90%, the investor can still lose badly in TAO terms, which in my opinion is the only thing that counts. And this is especially important because many investors look at subnet staking dashboards and focus on the yield number without properly considering token price risk. This is how people get hurt. They see a subnet with high APY, they stake TAO into it, they receive more alpha tokens, but then the alpha token falls so much that the yield doesn't matter. Think about Ridges, one of Bitenso's highest valued subnets recently, and it has gone down dramatically. Or Sports Tensor, which is now called Almanac. This also was a top 10 token, and now it's almost dead in terms of its price. And this is why dTAO investors should think less like passive yield farmers and more like early stage venture investors operating in a liquid market. And the question is not where's the highest APY, the question is what's the probability that this subnet token preserves or increases its TAO denominated value over time. And that's a much harder question to answer. And another thing is the lower bound is also unclear. Like a few months ago, some of the lowest ranked subnets traded around 0.001 TAO. And more recently, some low-end prices appear closer to 0.003 TAO. But what is this floor based on? Is it based on fundamental value? Probably not. It's more likely based on a mix of speculation, registration costs, optionality, emissions, market psychology, and the idea that even a weak subnet may have some value as a live slot inside Bitensor. But again, this is not a true valuation model. It's price discovery in a very young market. And that matters because investors may mistake a temporary market floor for a fundamental floor. And a subnet trading at 0.003 TAO may look cheap, but cheap compared to what? If there's no revenue, no users, weak team execution, and no buyback policy, it may still be very expensive. And in dTAO, low prices does not automatically mean good value. High price doesn't automatically mean quality either. And the biggest risk for low price subnets is of course deregistration, or for the people who stake into these subnets. So now let's have a look at the game theory of buybacks. In the long run, I expect buybacks and revenue transparency to matter much more than they do today. Imagine two similar compute subnets. Both provide useful GPU-based services. Both compete for miners, validators, and investors. And one uses 50% of revenue for transparent buybacks. The other uses nothing. As an investor, why would I stake into the second subnet if the first one is clearly more aligned with token holders? Over time, this should create competitive pressure. Subnets that generate revenue and return part of that revenue to the token should become more attractive. Subnets that generate revenue but do nothing for token holders may be punished. And subnets that generate no revenue and have no credible path to revenue may eventually lose market confidence. This is the positive long-term vision for dTAO. BitTensor becomes a giant evolutionary machine. Subnets compete not only on technical performance, but also on economic alignment. The market begins to filter. Weak subnets lose capital, strong subnets attract it. Revenue-producing subnets gain power, and buyback discipline becomes a competitive advantage. And if this happens, the demand for TAO could become much larger. Why? Because to gain exposure to subnet tokens, investors and subnet owners need TAO. If high-quality subnets increasingly perform buybacks, and if investors increasingly allocate toward revenue-generating subnets, as well as subnet owners who do buybacks, then TAO becomes the gateway asset into a growing internal economy. And that's the bullish theory. But it depends on one crucial assumption. The market must become better at recognizing quality. And right now, I'm not convinced it does. One of the most practical improvements would be standardized buyback and revenue reporting. Every subnet should make it easy for investors to answer basic questions. How much revenue does the market generate? How much of the revenue is used for buybacks? Are buybacks automatic or discretionary? How often do buybacks happen? Are bought back tokens burned, restaked, or held in a treasury? How much miner sell pressure exists? What percentage of emissions is covered by revenue? What's the subnet's cost structure? And without this information, and this is actually the truth at this moment, in my opinion, investors are flying almost blind. Subnets like Shoots and Bitcast already provide more clarity than most. That's good, but this should become the standard, not the exception. If dTAO wants mature capital, it needs mature reporting. Not because every subnet should be forced into the same model. Research subnets, compute subnets, agent subnets, data subnets, and consumer-facing subnets will all have different paths to value. But investors need comparable information to judge whether a subnet is making progress or simply absorbing emissions. There's also a broader question around root APY. You can stake your TAO into root without any risk, and you get yield. Some people have suggested that root APY should be reduced or removed even, so that TAO holders are pushed more strongly into subnets. And the logic is very understandable. If holders can earn relatively safe yield on root, they may avoid subnet risk. Lowering root yield could increase subnet participation and deepen dTAO markets. But this is controversial for a reason. A conservative root yield may be healthy. It gives long-term TAO holders a base option. It allows people to believe in BitTensor without forcing them to underwrite individual subnets. It may reduce reckless behavior and make the ecosystem more attractive to cautious investors. It's like buying index funds such as the S&P 500 instead of picking individual stocks. And forcing everyone further out on the risk curve could increase subnet liquidity, but it could also make the system feel less stable. And the better question is not simply whether root APY should be removed. The better question is what balance between conservative TAO holding and active subnet risk taking best supports BitTensor over the long run. And this is an ongoing discussion. I think dTAO will probably go through several phases. The first phase is speculation, and this is where we are now. Prices move heavily based on narrative and founder reputation. And many subnets are mispriced. Some serious teams are undervalued and some weak subnets are overvalued. And the market is very noisy. And the second phase is differentiation. Investors begin to separate subnets by category. Compute subnets are judged differently from research subnets. Revenue generating subnets are separated from purely experimental ones. And the third phase might be transparency. Subnets publish revenue, buybacks, emission coverage, and treasury policies. Investors begin to reward clear alignment and punish opacity. The fourth phase could be consolidation. Weak subnets disappear, get deregistered, or lose relevance. Stronger subnets accumulate more capital, more miners, more users, and more trust. And the fifth phase could be institutional understanding. If Bitensa succeeds, outside investors eventually stop asking which subnet has the highest APY and start asking more serious questions like which subnet has a durable demand, defensible infrastructure, and credible revenue and token holder alignment. And that's when dTAO becomes more investable. But we ain't there yet. And the main lesson right now is simple. dTAO is early, very, very early. This is not a mature market with stable valuation models. It's a live experiment, very exciting by the way, in decentralized capital allocation. The upside could be enormous if Bitensa succeeds in creating a market for machine intelligence and digital services, but the risk is also very real. Investors shouldn't assume that high APY protects them. They should not assume that buybacks automatically create a floor. They should not assume that a famous founder, an exciting category, or a high subnet rank guarantees future returns. They should ask harder questions like what does this subnet produce? Who uses it? Does it generate value or revenue? Does that revenue flow back to the token? How much sell pressure exists? Are miners being paid enough to keep producing quality work? Is the team transparent? Does the token have any reason to appreciate besides speculation? And most importantly, am I buying the subnet at a price that already assumes success? And that last question matters most, because in dTAO, as Shoots shows, even a strong subnet can be a bad investment if bought at the wrong price. Or at least in the short term, we don't know, of course, the long term. Maybe Shoots will go back to 0.4 tau. I don't know. So yeah, I think dTAO is one of the most exciting experiments in crypto. It may become a new way to fund, coordinate, and scale digital infrastructure. It may force subnets to become economically honest, and it may turn tau into the gateway asset for a large internal economy of AI, compute, data, agents, storage, and other digital commodities. But today the market is still learning. It doesn't yet know how to value subnets properly. It doesn't consistently reward revenue. It doesn't consistently reward buybacks. It often rewards narrative more than fundamentals. It sometimes prices possibility higher than actual performance. And all of this is very normal for an emerging market. But investors need to understand what kind of game they are playing. It's not passive yield. It's not simple staking. It's not equity investing. It's a new kind of liquid, reflexive, incentive-driven capital market, which makes it exciting, but also dangerous. And the next few years will likely determine whether dTAO becomes a serious capital allocation machine or just another speculative rotation game. I hope this won't be the case. And my guess is that it will become more serious over time, but only if the market learns to reward the right things. Real usage, real revenue, transparent buybacks, credible teams, aligned incentives, and long-term utility. So I know we are going through a rough patch in dTAO right now, with many subnets seeing big outflows, like 20-30% over a period of just a few weeks. And this goes to show that people have no clue, in my opinion, how to price these subnets. And yeah, so I'm very excited about dTAO subnets, but very cautious. And I would recommend people learning about subnets also to be very cautious. Don't fall for influencers who say to buy this subnet because it's very cool. Do your own research, and especially don't put too much of your valuable tau into subnets if you don't like taking big risks, because we are still so early. So if you want more information, you can always check out my website, discoverbitensor.com. Thanks for listening, and have a nice day.